Energy stocks have been on a tear since the war has begun. What do you do now? Check out our video to find out. Hi, Jim Gore from THOR Wealth Management. Well, if you look at our market update back in February 5th of this year, we were talking about the technicals of the stock market looking weak, except for one area, which was energy. So I have here an updated chart of energy sector, and this is looking at the XLE, which is the large companies that are in the S&P 500 in the energy sector. And you can see when we talked about February 5th, it was starting to break out, and it's broke out even more. The stock has done very well. Energy stocks have done very, very well, especially with the war coming up here after a long period of underperforming and it caught in a range. So we were saying, watch out, this is a breakout, and it's worked out very well. So the question is, what do we do now? Well, on this chart, I have a couple of indicators to look at, and I put an arrow to each of those. First is RSI, which is relative strength. And basically where it is, you can see it's green. That means that energy right now is overbought. And this is looking at the weekly chart. One thing that's very interesting, if you look below the price, the second arrow, that is volume. Two things. One is, if you look at so far this year, volume has been higher than it has been historically, and all of it is green, which means that's positive volume going in there, positive days, which is highly unusual, which means a lot of money is going into that. And that is being reflected in the fourth arrow, which is looking at the money flow index. And you can see money flow has been going into it. And the third arrow is looking at MACD. And what that means is momentum has really shifted to energy stocks. But you have to be somewhat careful because of the overbought range. A lot of money has gone into it. RSI, when it comes to overbought here, you should be expecting some sort of pullback. Doesn't mean that energy is over. What it's saying is that, hey, right now, a lot of people have been putting money into energy. And if anything happens with this war where it's settled quickly, you could see some of that energy stocks actually come down. So if you did what we said back in February 5th, added to some of your energy, now might be a time to take some of those gains off the table. But another way to look at the flow of money going into it, this is looking at the XLE, which is the exchange traded fund for energy. You can see that the purple line, the amount of assets in the fund have grown 65% so far this year. The return has been almost 40%. So if you had energy stocks, even though stock market is down this year, if you just had energy, you're sitting pretty. You're up 40%. But notice that you have a 25% growth in the assets. This is a $65 billion fund. That's a huge amount of money going into it this year, which is reflected in the money flow index that I showed earlier. So a lot of money has gone to it. A lot of it has been hot money, and that's what happens. I've been through some of these wars. When Iraq invaded Kuwait, you have energy stocks do very, very well, but if it settles down, those do tend to come back, and probably you will see some retrenchment in some of the prices of energy, especially some of the large company energy stocks. Now, this I think is very interesting, is that a lot of people have indexed their portfolios, and they're in the S&P 500. Back in the 1980, when we had the last oil crisis back in 79, when Khomeini came into office, and we had the Iranians holding our hostages, you can see here that energy was 25% of the S&P 500. It has gone down dramatically. In 2000 it was 6%. Today it is just 3%. So the impact being up 40%, if you're in the S&P 500, energy really didn't have that big of a move. Maybe it was up 1%, but this is why the S&P is negative this year. If it was like 1980, where energy was 25% of the index would be up pretty significantly this year. So energy is significantly underweighted in all the major indexes, which offers an opportunity for investors. Now, this week, I want to talk about the focus chart that we have is looking at bonds. And this is looking at the 10-year Treasury yield. On the left-hand side, in the last month, we've seen a big rise in interest rates. We've seen the 30-year or the 10-year Treasury go from under 4% to 4.4%. So that's been a big move, and it's all over the news that interest rates are going up. But let's put it in perspective. Look at the right-hand side. This is just looking at the last 3 years. You can see that interest rates in January of last year were significantly higher on the 10-year Treasuries. We were over 4.8%, and now it's 4.4%. So interest rates are still lower than what they were a year ago. So even though we've had this big move here, this is not the end of the world for interest rates. This is not something that we believe is going to cause a major impact on the economy with higher interest rates. Yes, you're going to see some people not buy homes because interest rates have gone up a little bit, but it's not as devastating to the economy as it could be if interest rates went higher than where they are or where they've been in the last 3 years. If you have any questions or need any help with your portfolio, reach out to us at THORWealthManagement.com or give us a call. Take care and talk to you in a couple weeks.
Subscribe to the THOR channel today.